Fixed rates continue to climb this month, even though the Bank of Canada is now expected not to increase interest rates at their March 8th meeting. So the question is, why, even though the Bank of Canada isn't going to increase interest rates, are fixed rates going up? And why are bond market yields going up? Well, the answer to that question is very simply that the market is expecting rates to remain higher for longer. But before we get into all the details and before I show you exactly what the rates are this month, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit that like button so more people like you can see this video. And don't forget, this is your last chance to get my new book, Mortgage Secrets, for free. All you have to do is pay the shipping and handling. Go to mortgagesecrets.ca in order to get yours. Okay, so bond market yields are continuing to rise, which is leading fixed rates to go up. And the reason for this is, like I said in the intro, that the market is now expecting interest rates to remain higher for longer. And this is largely to do with the fact that the Federal Reserve in the US is continuing to increase interest rates, while at the same time, Canadian job reports are coming in higher than expected. Now, there is some good news. Growth in the economy in Q4 was lower than expected. In fact, it was pretty much flat, which is going to help with inflation. But there's still some pieces to that inflation puzzle that are remaining sticky, which could cause the Bank of Canada in the coming months to start raising interest rates again. But as of right now, it looks like we're going to be okay from the perspective of variable rates and that key overnight lending rate. But that doesn't mean that we aren't going to see some higher rates with respect to fixed rates in the coming months. So let me show you exactly what's happening with respect to the bond market. Of course, the bond market is what we watch in order to determine where fixed rates are going. This is also what the banks use in order to price their fixed rate mortgages. And as you can see, this is substantially higher than it was a month ago. And if we go back and we take a look at the 3-month chart here, what you can see is that interest rates jumped up, then they came back down, and now we're seeing them start to rise again. And again, this is because of the jobs numbers and the expectation that interest rates are going to remain higher through the end of the year. And with higher bond yields and with the market expecting higher rates, that leads 5-year fixed mortgages to start to go up in price. And they've done this basically from the start of February right through until the end of February and into early March. We're now seeing 5-year fixed rates about 0.2% higher than they were at the beginning of February. And it looks like we could see further increases coming as March rolls on. So stay tuned to this channel if you want to see updates on that. Make sure you hit that subscribe button and hit that like button. Now, with respect to where mortgage rates are as of today, I'm going to jump you in and we're going to show you exactly where rates are. Now, of course, we always start with our 5-year fixed full feature mortgages. These are the mortgages that come from non-banks that have the best payout penalties and the best product features because, quite honestly, they have to, right? They can't compete with their big bank counterparts with respect to their marketing budgets. So in order for these companies to survive, they actually have to have better products with better rates, with better terms in order to make sure that they continue to have clients and consumers choose them for their mortgages. These are companies like First National, MCAP, CMLS, some of the best lenders in the country who deal with some of the best clients. And these are the types of mortgages that you want to make sure that you have just in case at some point mortgage rates do come down, because these will be the mortgages that allow you to refinance into lower rates in the future if that happens. If you have a big bank 5-year fixed, you're probably going to be stuck paying that high mortgage rate for the long term, just like the people who had them in early 2020 when interest rates went super low. The people that couldn't get a lower mortgage rate going forward were the people who had those big bank 5-year fixed with the big penalties. So let's take a look at what these rates are. First and foremost, for insured mortgages, these are the safest mortgages for the banks because they have CMHC or Sagan or Canada Guarantee insurance on it, which means if a consumer defaults, the bank is protected from any losses. So these are priced lower than most other mortgages, and they are 4.99%. Now, at the beginning of February, they were around 4.79%. Now, as you start to get to the point where you put 20% down, these are the most risky mortgages for the banks. It used to be thought that these would be the mortgages that you'd get the best rate on, but these are the mortgages where the banks have the most exposure because they don't have insurance. So subsequently, when things like the market dropping 20%, which I'll link to the video about that at the very end of this video, but when the market drops 20%, these are the mortgages that the banks have the most exposure on and therefore are priced typically the highest. So at 20% down, you're looking at 5.29%. At 25% down, you're getting a little bit bigger down payment, a little less risk, a little bit lower rate, you're getting to 5.19%. Then at 30% down, you're looking at 5.09%. And then once you cross that 35% threshold with respect to your down payment, this is where mortgages are considered to be super low risk for the banks. Again, they don't have insurance, but the chances of somebody walking away from a mortgage where they put 35% down is pretty low. So the interest rate returns back to that 4.99% insured rate. And then if you're looking at purchasing over $1 million, if you're looking to refinance, if you're looking for a 30-year amortization, these are what's called uninsurable mortgages. So these are the types of mortgages that legally you can't get insurance on in Canada. CMHC, Canada Guarantee, Sagan, those companies will not provide insurance. So these mortgages tend to be priced even higher. They're starting at about 5.49% right now. Now, moving into variable rate mortgages, these are the full feature mortgages. Obviously, prime rate is at 6.7%. No expectation of this changing on March 8th, which is when the Bank of Canada next meets. So you're going to see prime at 6.7%. You can get an insured mortgage at prime minus 0.9, which puts you at basically 5.8%. So the fixed rate mortgages, as long as you're getting a non-bank mortgage that doesn't have a big penalty, and you're not getting a discount mortgage, which I'll cover in a second, are starting to look pretty good. And if interest rates go down, you simply pay a penalty and you'll be able to get a lower rate in the future. So fixed rate as of right now, using our rule that you always choose the mortgage that has the lowest interest rate at the time you get the mortgage, is starting to look pretty good. Now, as we start to get into 20% down, these are priced at prime minus 0.55. So you're basically looking at 6.15% on these. At 25% down, you're looking at the exact same rate. 30% down, a little less risk, a little better rate. You're looking at basically 5.95%. And then at 35% down, you're looking at that insured-like rate of 5.8% again. And then getting into uninsured, refinance, $1 million plus, well, you don't get as good of a deal on these. So you're looking at basically 6.3%. So again, those fixed rates are starting to look pretty good again with respect to choosing a mortgage in 2023. Now, I suspect that this will even out at some point in the future, but when is anybody's guess. Now, moving into discount mortgages. These are the types of mortgages that have restrictions or reduced prepayment privileges. You don't get something for nothing. So in other words, you're going to pay a lower interest rate, but they've stripped out some of the features. And the one thing that you really have to watch out for on these is what's called a bona fide sale clause. So what a bona fide sale clause means is that you cannot get out of the mortgage unless you sell the property. So in other words, you can't come up with a bunch of cash and pay it out. You can't switch to a different lender. You pretty much are stuck with that lender until the end of the term. Now, this ensures profitability for the lenders, so they give you a lower interest rate, but it also makes it so it's impossible for you to switch to a different lender and get a lower interest rate if interest rates go down. So you'll save a little bit of money, but I don't think it's enough money to warrant the added restrictions that will end up costing you money down the road. Because when you lose that ability to switch to a different lender, you lose all your negotiating ability, all your negotiating power. The lender is in control and therefore you're going to be stuck. So this is the type of mortgage that could end up costing you $10, $15, $20, $100,000 more because you chose the wrong one when you went to choose your mortgage because you were only focused on rate. And like I've said in the past, product, penalty, and price in that order. You want to look at the product first, then you want to look at the penalty costs, and then you want to look at the price. Don't do it the other way around because that's what leads people to find themselves in these discount mortgages. So that being said, I believe in transparency, so I'm going to show you exactly what these are. For an insured mortgage, you pay about 0.2% less than you would for a regular mortgage, which equates to about a cup of coffee a week, depending on the size of the mortgage. It might be a Starbucks, it might be a Tim Hortons, and if it's a really big mortgage, it might be for two of you rather than just one of you. But the bottom line here is the difference between these rates is probably less than your coffee or your beer or your wine budget on a regular basis. So be careful when you're choosing these for basically a 0.2% benefit. Then getting into 20% down, you're looking at 5.04%. At 25% down, you're looking at 4.94%. At 30% down, you're looking at 4.84%. And then again, when you get to 35%, you get to those insured type rates at 4.74 because these are, again, really low risk for the lender. These discount mortgages are even lower risk for the lender because you can't leave. Then when we get to uninsurable refinance, $1 million plus, these are the types of mortgages that typically don't have great discount rates because the lenders tend to use back insurance. So in other words, insurance that they pay for in order to make the discount rates really, really low. Now, getting into variable rate discount mortgages. For insured mortgages, you're looking at prime minus 1.15. So in other words, you're basically looking at 5.55%. For 20% down, you're looking at prime minus 0.8. For 25% down, you're looking at prime minus 0.8 again. At 30% down, you're looking at prime minus 1, so 5.7%. And then at greater than 35% down, you're looking at prime minus 1.15. So nothing has really changed with respect to variable rates over the last month. But again, those fixed rates have gone up pretty much 0.2% across the board. And I suspect that they're going to go up even further in March. Now, that being said, what data comes out in the next couple of days is anybody's guess. There could be even more upward pressure on rates, or there could be downward pressure on rates. It's hard to tell, especially at the beginning of the month, but stay tuned, like I said, to this channel because I'll keep you updated when those interest rates change. And like I mentioned at the beginning of this video, there's some really interesting real estate data. A lot of the markets in the country are down, although a lot of them are also doing fairly well. So my most recent video talks about that. I'm going to link to it right here.